NIO stock has once again had a bit of a rough session, but importantly it's still holding above that key $6 level. For investors who've been following the company closely, that psychological support has become something of a litmus test for sentiment in the short term. The stock most recently traded around $6.13, down about 3% on the day, after bouncing between an intraday low just under 6 and a high of $6.19. While another red day isn't what the bulls were hoping for, the fact that NIO has managed to maintain a floor above $6 despite heavy volume is a sign that there's still resilience in the name. The bigger picture here is worth keeping in mind. Since the start of the year, NIO shares are still up roughly 40+%. That's not insignificant, especially for a stock that spent much of last year languishing in the $4 and $5 range. The recent pullbacks, as frustrating as they may be in the moment, need to be considered against that broader trend of recovery and renewed interest in the company. Even if we're seeing some choppiness now, the gains over the year speak to a market that is starting to believe in NIO's turnaround story. A lot of that belief has been built on the back of some impressive operational results. In August, NIO delivered more than 31,000 vehicles, which was a record for the company and represented a 55% year-over-year increase. That kind of growth doesn't just happen by accident. It reflects a product lineup that's resonating with consumers, particularly with the addition of new models under the Onvo brand and growth in the Firefly line. These vehicles are hitting the right price points in a fiercely competitive Chinese EV market, where affordability and brand differentiation are becoming key battlegrounds. The company's most recent quarterly earnings also gave investors reasons to be cautiously encouraged. Revenue came in at $2.7 billion, beating expectations, and operating losses narrowed more than analysts anticipated. NIO still lost over $500 million in the quarter, but the trajectory is what matters here. Losses are shrinking, margins are ticking up, and the path toward profitability, while still not immediate, looks clearer than it did a year ago. Gross profit margin improved slightly to 10% from 9.7% a year ago. That's not earth-shattering progress, but it's directionally positive at a time when many peers are struggling to protect margins in the face of relentless price competition. One headwind that remains very real is average selling prices. NIO's cars are now averaging around $31,000, down from $38,000 last year. That's a reflection of the brutal price war that Tesla and others have ignited in the Chinese EV space. But here's the counterbalance: lower average selling prices are being offset by higher volumes. By driving sales higher through competitive pricing and compelling models, NIO is keeping its factories humming, increasing its brand visibility, and laying the foundation for better economies of scale. Investors need to see this as part of the trade-off, short-term pressure on per-unit profitability in exchange for long-term market share gains. Another interesting data point is trading activity itself. On Wednesday, volume came in at 89 million shares, well above the 50-day average of just under 72 million. High trading volumes on down days are often interpreted as cautionary, but they also show that the stock is attracting strong attention from both retail and institutional players. Where there's volume, there's interest. That can set the stage for stronger rebounds when sentiment shifts. Right now, that $6 level is acting as a magnet for both buyers and sellers, and if NIO can manage to stabilize and hold it, the next move could just as easily be higher. Analyst sentiment remains a mixed bag, which actually plays into a cautiously optimistic narrative. Citi analyst Jeff Chung has reiterated a buy rating with a price target of $8.10, citing confidence that margins will improve and that cash flow will turn positive over the next few quarters. Bank of America Securities is also relatively bullish, lifting its target to $7.10 on the back of a strong model lineup. On the more cautious side, Freedom Capital Markets recently downgraded NIO from buy to hold, though interestingly they raised their price target from $4.90 to $6.50. That's a subtle acknowledgement that while risks remain, the stock's fundamental trajectory is improving. In other words, even the skeptics are having to nudge their expectations upward. It's worth remembering that NIO's story isn't just about the vehicles it sells today. The company continues to expand its battery swap infrastructure, a unique differentiator in the EV landscape. While rivals focus exclusively on charging networks, NIO is betting that giving consumers the ability to swap a depleted battery for a fully charged one in minutes will be a long-term competitive advantage. This system not only reduces range anxiety but also creates recurring revenue streams as drivers subscribe to battery services. It's an ecosystem play that could pay dividends in the long run, even if it requires heavy upfront investment today. Looking forward, NIO has guided for third-quarter deliveries of around 89,000 vehicles. If achieved, That would set another quarterly record and solidify its position as one of the leading Chinese EV players. Achieving those numbers will hinge on continued consumer demand for its new models and the company's ability to manage production efficiently. For investors, this upcoming quarter could be a real litmus test. If NIO delivers as projected, the stock could find renewed momentum and potentially climb back toward the upper end of analysts' current targets in the $7 to $8 range. Of course, risks remain. Competition in China is intense, with companies like BYD, XPeng, Li Auto, and even newcomers like Xiaomi all pushing aggressively into the EV market. Tesla remains a formidable force as well. Any misstep in execution, whether on pricing, production, or technology, could erode NIO's fragile gains. On top of that, global macroeconomic uncertainty, including potential slowdowns in Chinese consumer demand, foreign exchange risks, and shifting regulatory policies, could all weigh on the company's outlook. This is why investors need to temper their optimism with a healthy dose of caution. Still, the narrative has shifted meaningfully compared to a year ago. Back then, NIO was being written off by many as another struggling EV name burning cash without a clear path forward. Today, while it's not out of the woods, it is showing tangible signs of progress. Record deliveries, narrowed losses, and modest margin improvements all point to a company that is fighting hard to carve out its place in one of the most competitive industries in the world. That deserves recognition. For long-term investors, the question is whether NIO can keep scaling, keep improving its financials, and ultimately turn profitable. The pieces are there: strong product momentum, innovative battery solutions, and a loyal customer base. The challenge is execution, delivering consistently quarter after quarter while fending off rivals and maintaining financial discipline. So where does that leave us? NIO at just above $6 looks like a stock caught between skepticism and hope. On the one hand, bears argue that profitability remains distant, dilution risks are real, and competition is only getting fiercer. On the other hand, bulls see a company with accelerating sales, improving fundamentals, and a valuation that looks attractive compared to where it could be if execution continues. The truth, as usual, probably lies somewhere in the middle. For now, the cautious optimism is warranted. Investors have reasons to believe in NIO's growth trajectory, but they also need to keep one eye on the risks and accept that volatility is part of the package. In the coming weeks and months, holding that $6 level will be important. If the company can back that technical support with continued operational strength, the stock may well find its way higher. But patience is key. This is a long game, and NIO is still in the middle innings. As always, none of this is financial advice, and you should do your own research before making any investment decisions. But from where things stand, NIO continues to be a story of progress, setbacks, and potential, a stock worth watching closely, even if the path forward is anything but smooth.